Okay, this video is just about how to find the A, B, C levels. So I'm just going to look at the pound dollar here. So how I find A first is by a swing low. So whenever you see a swing low put in, which is right here, and then a rally, you have a swing low and a swing high. And once you see that price is starting to come down, then you know you have your swing high in place. So we had, and it's always the most recent on whatever time frame you're trading on. So here we have a swing low and we have a swing high, and then we have a pullback. So once you get your swing low, you label that A and you wait for your swing high. Once your swing high is put in and you see price has made a top, and you can usually tell by the candle formation like you see right here. So we have a swing high then, and that is B, and we go ahead and put B in. And once we get that swing high, what we're looking for is the entry. And how we find the entry is we fib from A to B, the most recent swing low to most recent swing high, and we wait for C. And C usually falls. What happens is this: either you'll find that the pair on whatever time frame you're looking at will form a bull flag, or price will continue down and test one of the fib levels. So in this case, price came down and tested the 50%. Now, I know you're thinking, well, we did kind of stop here and go up. And well, first of all, I don't usually take an ABC trade off of the 23.6, and most of the time off the 38.2. The only way I'll do that is if price forms a bull flag. Okay, let's say it formed a bull flag and price did come down to the 38.2. I will wait for a close above the bull flag trend line in order to trade that. Okay, but when I trade the ABCs, I like price to at least test the 50% retracement, if not the 61.8. So what I'm looking for, once B is formed and I have my swing low and my swing high, B is formed, I'm looking for price to either form a bull flag, and if it does, I will trade that on a close above the trend line, the upper trend line. If price continues down and we test the 50%, I'm looking for C to fall on the 50 or 61.8 or the 78.6% fib. That's where I'm looking for C, and that's where I'll enter the trade at unless I have a bull flag. So in this case, price came down and it looked like it was going to form a bull flag, but it didn't give us an opportunity to go long because we didn't close above the bull flag trend line until we tested the 50%. So I did not take this trade. I was looking at it, did not take it though, because this all happened a few minutes before FOMC came out. But I was watching this. So on a normal basis, I would know that, okay, I have a swing low, a swing high, looks like we're forming a bull flag, but price is still coming down a little bit, so I'm not going to be trading the bull flag. But here we tested the 50% retracement, which also happens to be supported by the 200 EMA, which is yellow line here. I would take that trade right there. Okay, now what I would do, that would be C. That's labeled my C. Now what I would do in this instance is I probably wouldn't take as large of a position as I would if price came down to the 61.8 or 786. The reason for that is because C can still be the 61.8 or the 786. So around the 50%, I'm going to take a smaller than normal position, anticipating that the possibility of coming down to the 61.8 or 786 is good. So let's say I took the trade off the 50% with a smaller position than normal. Everything worked out fine in that instance. But let's say that I went ahead and took this figuring that we're right on the 50%, we're right on the 200 EMA, so I'm going to go ahead and take it off the 50%, but I'm going to go in a smaller position because if I come down to the 61.8 or the 786, I want to add a little bit to it because I'm not in a full position that I normally trade yet. So I can afford to add a little bit to it. So around the 61.8, if price came on down, I would go ahead and add a little bit, or maybe depending on what the candle looks like, and I'd probably be able to tell that we may be coming down to the 786, and if that's the case, I would wait for the 786 and add to the position there. And then I would have my stop on a close below the 786. So at this point then, if price, say I bought here at the 50%, but price continued down through the 61.8, tested the 786, I'd add right there. Now I'm in at a full position, and my stop would be just to close below the 786. So that's how I would work that. So to find A, B, and C on an AB equals CD pattern, it's just the most recent swing low to most recent swing high on the time frame you're trading. And you wait for either a bull flag to form or C to form off of one of the fib levels. And the most successful ABC pattern trades that are almost guaranteed to work are when you have bullish hidden divergence on this MACD adjustable indicator. And right here you'll see bullish hidden divergence, and that's where the most recent low is higher than the previous low, but the MACD bars are lower than the recent MACD bars. So this was a trade that was about 80 to 90% possibility of success, because not only do we have an ABC off the 50% retracement with the 200 EMA as support, we also had bullish hidden divergence. So there was 3 things supporting this long trade. You can still trade these ABCs without the hidden divergences, but to add probability to your side, having the hidden divergence in your favor is always best. And also, always going with the overall trend, trading these ABC patterns with the overall trend is what is very important. At least if you're going to trade off of the 15-minute chart, you at least need, and you're going to go long on it, you at least need the 4-hour chart to be in an uptrend. So that's how I find the ABC patterns.